Hello everyone and welcome to today's major markets update for Monday the 16th, 2022. I hope you all had a great weekend, rested up and are ready for this week. So let's see what we get. And please remember, it is always good to get a reminder. The Elliott Wave principle is first and foremost an interpretation of the price action. We make choices based on firm and hard Elliott Wave rules on what it should or should not be, which then in turn leads to crisp and clear if-then scenarios. If we break higher, then we get this. If we break lower, then we get that. Quite simple. And that is on all time frames. So depending on your focus, short term leads of course to more changes in the Elliott wave because our interpretation is never 100% right. We are right if we're good around 70% of the time. It'd be too easy for the market to be able to analyze it correctly all the time. Then the market wouldn't function. That leaves us then to, once we have been able to identify 5 waves lower or 3 waves lower in this case, meaning lower in this case, not necessarily 3 or 5, expect then at the minimum 3 waves back up, because after 3 waves lower, you don't know yet if the correction is complete or if it's going to get more complex. A zigzag 353, which is 3 waves lower, can turn into a flat 353 zigzag down, zigzag back up, 5 waves lower, or a triangle, for example. So one door at a time. Once we have gone through one door in the market, we've gone through one probability or possibility, sorry, and then 2 more doors open. Very simple, okay? That's always our 2 more doors are faced through which one of them will take. So please keep that in mind. It's not the Elliott wave is wrong. The Elliott wave is always right. It's the interpretation by the Elliottian that is either wrong or right. And it can never be right all the time. That's very simple. So that's why we always have stops in place. If you don't know what stops can do to you, please take a look at the Lund chart. It went from 120 to 0 in about a month. Now, I'm not saying the stock market is going to go to 0. In fact, no, the stock market will not go to 0. Not tomorrow, not next week, not next month, not next year, not next decade, and most likely not even this entire century. So with that in mind, always remember your risk reward ratio. I'll get to that in a minute. Here is the Dow Jones. The Dow Jones has so far done 3 waves lower. It failed a little bit to reach its CSA target zone. This is my interpretation of the price action based on what I'm seeing. I cannot count the correction in January as 5 waves lower. Some people do. I have no 5 waves lower. This is 3 down, 3 up, 3 down, 3 up, likely 5 down. Honestly, the Dow Jones also counts better as 3 down. So it looks like all 3s. All right. If I would really be fair and honest, the Dow Jones just also did 3 waves lower. Here, I have a hard time counting it any other way. Something like this, A, B, C. That's not the same as for the S&P 500 or any other index. Okay, every index on its own, in my humble opinion, the S&P 500 did crisp 5 waves lower. So what we can expect is, at the minimum, 3 waves back up, as I show you here. And then we might get some sort of double type of zigzag. I know zigzags are 535s. I cannot even get the internals of the A wave. But corrections can also maybe turn into something else that we might not even have identified. It's very, very possible. That way, we will see a bounce back to about the Federal Reserve highs on that dreadful Wednesday, which was reversed on an even more dreadful Thursday, depending on if you were long or short the market. And we get some sort of double zigzag back to about this CSA level. That's option 1 for the Dow Jones. Option 2 is that we indeed completed 5 waves lower. Using the closing prices, I kind of can count it. There's one little wave I cannot account for. But again, if we can get 90% correct, that 10%, I'll be fine with it. And here are the what I call risk levels to look from the long side: high risk, medium risk, low risk. High risk means that there's a high chance of moving below last week's low. That now needs to hold to say the correction is complete or the first step of the final correction low is also complete. The A wave, the B wave, and then the C wave. We haven't even gotten to this high risk level. Medium risk means we have a lesser chance, and a low risk means a lower chance even at that, okay? There is no risk, of course. So this suggests wave 4 has completed, and a simple A, a B, and a C correction. Whatever it is, this is what it is. We bottomed at wave 3, we topped at wave 4, we overextended for wave 5. As you can see here on the upper left-hand corner, I haven't used it in a while, is the traffic light. Price is below all the moving averages, and all the moving averages are bearishly stacked, meaning the 10 is below the 20, is below the 50, is below the 200. By no means is this a bull market. This is a bear market setup. Doesn't mean we are in a bear market. That's something entirely different. Please give me the definition of a bear market, and I'll give you 10 reasons why it's not a bear market. My definition for a bear market is a multi-year decline of at least 50%. Not so 30% decline intra-year, we close higher. No, we need to see several years of downside. That is, I think, a much better approach than just some arbitrary 20% cutoff. If that's the case, we've been probably in about 5 or 6 bear markets since 2009. Doesn't feel that way if I look at what the index has done since. Regardless, high risk, medium risk, low risk. This is on a daily time frame. We can also have these levels on a hourly time frame, a yearly time frame, etc. It all depends on your trading time frame, so to say. And yes, if you hold for a very long term, you're also trading, because trading is buying and selling. Doesn't matter when you buy and when you sell. Looking at the Nasdaq, I still view this as a major 3 and a major 4, and I'll get to you in a moment on why I view it that way based on the yearly chart. I know on Friday I said we have a potential for a cycle 3 top in place. It's a little bit on how you would label things, and then this would simply be the cycle 3 and this is the cycle 4. It really can be this way. Again, it depends on how you label things. Okay, again, the risk reward is really there from a long-term perspective. We're not going to zero, not at all. Even if the S&P 500 goes from 4,000 to 1,500, it can still rally to 10,000 over the next couple of decades. Then you have about 60% downside risk, so to say, at the most, versus a 200% upside potential. Please keep that in mind for very long-term investing. I'll get to that in a moment. It's all about risk reward, and no, we're not going to zero. That's utter insanity. So we've done 17 waves to the downside, can always extend to 21, but I've so far counted 17 waves. We've done enough. And now we'll just let the market decide if this is enough. Short term, fine with me, whatever we want to do. As long as we hold last Thursday's low, we can move higher for either completion of this wave 4 or for a B wave and a more complex double zigzag type of correction. Here is the Nasdaq 100 chart once again, now with the moving averages. Please keep in mind the traffic light on your left-hand upper corner is completely red. This is danger, danger. So we haven't even broken above the high risk level, which is at about 12,525. We haven't even broken above the high to medium risk. To medium risk, nothing. We have not broken out above anything. At a minimum, I would like to see us break above this trend line. Remember, once we start breaking out, we'll start to reach the upside targets, just as we did in February and March. We had this wedge, it completed, you got the breakout, easy peasy. It's got there where we had to at the beginning of the wedge. And now we simply have to see how we are going to fill all of this in shorter term. Same for the S&P 500. The S&P 500 has the same two options as I showed you for the Dow Jones. Either the low is in or we're going to subdivide. As I said, after 5 waves lower, expect at the minimum 3 waves back up, because we can always subdivide our correction. Nobody knows with certainty for sure. We've done enough. We've even gone a little bit below where we ideally should have bottomed, which was 4,040 to 3980. We've gone a little bit even below the 3925 CS8 target zone. So we've really done enough damage, so to say, for this correction. And this correction still on all time frames looks really like a B, and a Z. Okay, we can still subdivide it so that we kind of repeat this pattern here in January, February. This is A, this is B, this is C. it's possible. So I'm presenting you this option. That is the door, and I will see if the market will take this door, yes or no. High risk is a 4,050. We tagged 4,046 today, so no high risk trade entry based on the daily chart. We have a high to medium risk at about 4160, and medium risk at about 4300, etc. Why? Again, as I said, the higher we go, the less likely we're going to break, of course, below last week's low. That is, of course, now the line in the sand. Shorter term, there's even another option. Again, we're dealing with different time frames, so we have different interpretations for the price action based on the time frame. So here's the shorter term. I can still count a possible wave 5 lower to around 3,800. It is still possible. We haven't gotten above the cutoff level yet, which is at 4060. So that's why I have it here on the daily chart, okay? That's about the same level. So we can still have a 1, a 2, a 3, a 4, and a 5. Very possible. Once we start breaking, I would say below the opening gap here at about 39.25, this is the favored portion. And then I'm really starting to run out of waves to count for any time frame, all the way going back to, I would say, March. Then I'm totally running out of waves to count to the downside. That said, the other option is, of course, that we've completed a impulse following Zach Manes from Elliott Wave Trader. That he sees this as already 5 waves higher. It's fine with me. This is the short term. It's a 3-minute chart. It's speculative always because all these scribbles are open to interpretation. It looks like we have some sort of ABC type of flat wave 2, I believe, or zigzag wave 2, whatever it is. It means we should see a bottom here at around 39.50 in this target zone, rally to this. Oh, sorry, that's not 4. That's of course 3. There. This target zone, this target zone, this target zone for wave 1. Okay, there's only wave 1 of 5, etc., etc. Then we start to fractal our way higher. Okay, so again, you can see if we have topped here today for wave 1 of 1, then you can see a typical retrace holds this opening gap here. It fills the opening gap, but it holds it. I really don't want to see it go much below it, because that opens the door for this one last final stab lower. Again, it is possible to count the advance since last week's high as a completed impulse. Fine with me. Now, again, an impulse doesn't mean it's a wave 1. It can also be a wave. Where is it? Oh, I just closed that chart. It can also be a wave A. 5, 3, 5. Okay, so we keep our options open. I don't see it here, so that's not entirely objective and honest. That is kind of force-fitting things, but I agree that is one option. So this is A, B, and C. So we keep those 2 options open. Okay, that means, of course, the bounce looks higher and the impulse looks higher. The impulse simply looks at new all-time highs. The bounce suggests we're going to stall, as I said, at around the Federal Reserve highs, and which I call them that B wave or the 4 waves retrace here for the S&P 500. So we have our high risk, medium risk, low risk entries. Very simple. See the Dow chart for the explanations. Because if you enter, of course, very close to the bottom, the chances increase that we will go below the bottom. The further away we get from the bottom, the lower the risk. There is no risk. There are only stops. That's it. All right. No, if you want no risk, then yeah, this is not your game, so to say. So we've traveled through all the different time frames. Again, shorter term, we can even get one last step lower to 3,800. It's not my preferred view, but as I said, we've done enough damage. Can't exclude it yet. Then, of course, we get all this in the news on USA Today. Are we in a bear market? Okay, fear is mounting for stocks to continue to fall. When we start seeing this in the mainstream media, you probably have to consider that most of the correction is already over. All right, that's a really nice contrarian sign, so to say. So we start to see more of this stuff already in the general news, not in necessarily even financial news or very specified news outlets. This is very mainstream now. It probably means we're closer to a bottom than to a top. So zooming out even further, this is one of my most preferred ways to count the Elliott wave. Simply looking at down years. Okay, If we look at down years as corrective years, then we can count a beautiful Elliott wave pattern higher. We have here two patterns from the 40s into the 70s of subdividing wave 3, 13 waves, 9 waves, and now we're in a other impulse higher since the 2009 low, I believe it is, right? Yeah, 2009 low. And as you can see, 1, 2, this is technically 0.04 points below. So this is, although rounded equal, it is a down year. 3, 4, this was a down year. 5, 6, this was a down year. So now we should be in a down year and one more up year. That completes super cycle 3, super cycle 4, super cycle 5. Okay, so super cycle 5 should last a couple of decades. Okay, not just 2 years, but a couple of decades. Super cycle 3 lasted almost 100 years. So super cycle 5 probably lasts like 50 years, something like that. It's a guess, but it shows you bigger picture-wise, this is not done. This was correct, an impulse. Why is it an impulse? Because at a minimum 5 waves higher. If then the third wave subdivides, you get 9 waves higher. Here we have 13 waves higher, so then we had a subdivided third wave and a subdivided fifth wave, beautifully. Okay, so we still at a minimum need one more up year. So these are years. So this year should technically be a down year. Then 2023 can be an up year, and then 2024 can start the super cycle 4. That'd be preferred. Doesn't have to. It can even extend much further in time. But this one suggests that we're not in a bear market. And what would be a bear market? That would be something we experienced here in 2009, in the 70s, in the 40s, and in the 30s. Doesn't look like it, looks more like a simple yearly pullback. And as you can see, most pullbacks in the market of 100 years of data are only 1 year, meaning that we only get a 1 year of a lower close. 1, 2, 3, 4, 5, 6, 7, etc. So you can really see pullbacks in the market in general only lasted about a year. There are very few that last longer than a year. So chances are this is not going to last all that long. Now here is the Nasdaq chart and why I have aligned the Nasdaq 100 chart with that count as well, major 3, major 4. Yearly time frame, okay? Count it nicely. Look here in the mid 2010s, we had the picture perfect wave 4 pullback of about 23.6 to 38.2%. We should now be in major 4, should bottom somewhere here, doesn't have to, but should be. And then we get 5, okay? And then we complete a much larger. So this 5 of 3 is primary 3, can also be super cycle 1, super cycle 2, super cycle 3. It's a name, and then we get a much larger correction, just as we had here in the early 2000s, okay? Now note the moving averages. The 10-day moving, of 10-year moving average appears to delineate bull markets versus bear markets. Early 2000s, we closed below the 10-year moving average, bear market. Mid 2000s, we closed below the 10-year moving average, bear market. Ever since, we've not closed below the 10-year moving average. So technically, we have no indication this is a bear market whatsoever. I know it's going to take a while, but this is still a strong uptrend. We simply are selling from overbought conditions on a yearly time frame. So please keep these time frames in mind. If you're in it for the long run, if you start, for example, investing in your 401k portfolio, you should simply invest through these type of massive corrections because you're really averaging down because you're in it for decades, right? That's something else. You don't have to worry too much about it. At some point, you will have to cash in your chips or go to cash at something else. But for now, the trend is really strongly higher. As I showed you for the S&P 500 as well. This is, look at the big picture, right? The big picture. A yearly down year is not a bear market, not at all. That brings me to a chart from Bank of America. This was tweeted by Mike Saccardi. So this is on Twitter, where Bank of America looks at secular and cyclical bull and bear markets, going all the way back again to the 1929s. So it's pretty much all the data we have available, right? We can't just cherry pick data. So somebody says, oh, look, it's as extreme as the beginning of the 2008-9 market crash. Yeah, well, if you have data that goes back another 20 years, why don't you include that? That's not honest, that is cherry picking. So we have to look at the whole data. And what the Bank of America finds is that cyclical bear markets so far have happened in the 7th year of every secular bull. 2020, 87, 57. Okay, 3 out of 3, not bad. Then we have secular bull markets lasting anywhere between 16 to 20 years. And here they count the start of the bull market on the breakout above the consolidation path with a box the market has been in. Right, 2000, 2013, massive consolidation, essentially 2 bear markets. Also the 60s and to the 80s, massive bear market. By the way, here 1974 was like a 50% correction. Okay, so there was nothing to write home about. Like, oh, that was easy peasy. Now look at this. This was pretty much 2 decades of nothing, 66 to 1980. And then we get the breakout here as well from about 1934 or 37 to 50, 13 year, and this is about 14 years. So this looks pretty good. We have quite some nice symmetry going on here in sideways consolidation paths of about 13 years, and then a bull run necessarily is anywhere between 14 to 20 years. Does the current bull run have to be as long as 14 to 20 years? No, it doesn't have to, but it does suggest that we're in the 7th year of the secular bull. Pullback was 2020, so we should see a little bit more upside. And that fits with what I'm seeing here, 4 and 5, seeing here 8 and 9 as well. So again, a bigger picture perspective. I know this is not going to go to 0. So again, if we're in super cycle 3, if we are, I don't think we're going to go much below the 2020 lows or even the 2000 highs. I don't think we're going to revisit all the way down to the 2009 lows. That'd be, I don't think they'll ever let it happen, so to say. But I want to show you the bigger picture and the risk reward and why one doesn't have to freak out. Things are not going to 0, right? One should freak out if things go to 0. But I don't think the S&P 500 or the Dow Jones or Luna type of cryptocurrency, we're not there. It's always possible, but is it likely? No, none of the charts that I can see suggests we're going to go to 0. Even if super cycle 5 completes, that might even just be a grand super cycle. Who knows, right? So one step at a time, take a deep breath. We're not going to 0. We've never gone to 0, not even in the 1920s, 29 and 30s. I'm sorry, that was the worst market crash ever. We didn't go to 0. We'll not go to 0 again either. If anything, longer term, these are fantastic buying opportunities if you see it from that perspective. So I've covered all time frames. Please review the charts if necessary. They will come along pretty soon. Take care, trade safe, watch the high risk, low risk, medium risk type of setups and why they are like that, because the further away we move from a low, the less likely it is we're going to revisit that low. Again, nothing is set in stone. And why we have short term still a little bit of an option to go one step lower. But I would say intermediate term, using the daily chart, we can already start looking for either a bounce and then lower, or we are going to look for the start of the new impulse higher. All right, that's all I have for today. Thank you so much for listening. Take care, trade safe, and don't forget the traffic light is full on red, so we keep standing on the brakes. Take care. Bye.